Welcome to Galaxy Brains.
An infinite amount of cash.
I'm your host, Alex Thorn.
The U.S. banking system is sound and resilient.
Bitcoin made a new all-time high.
If you're not long, you're short.
Satoshi's going to come on there, laugh hysterically, go quiet, all Bitcoin's going to be erased.
Bitcoin's the best crypto asset.
Bitcoin is going to zero.
Welcome back to Galaxy Brains. As always, I'm your host, Alex Thorn, head of firm-wide research at Galaxy. Bitcoin not zero. We have a great episode for you this week. Luca Prosperi, CEO and co-founder of M0, a major stablecoin infrastructure provider, is our guest. We're going to talk with Luca about the flash crash from last week, the impact on DeFi and key takeaways on risk management and TradFi and DeFi, what microstructure may need to change to prevent this in the future. We'll also talk about the Genius Act and the growth of stablecoins and his picks for winners and losers 5 years from now when stablecoins are widely adopted. Very fascinating interview. And of course, I should mention that M0 is a Galaxy Ventures portfolio company. We'll also check with our good friend Beimnet Abebe from Galaxy Trading. As always, a nice spicy conversation about the Fed purporting to halt quantitative tightening and what that might mean going forward. Before we get to all of that, I need to remind you to please refer to the link to the disclaimer in the podcast notes and note that none of the information in this podcast constitutes investment advice or an offer, recommendation, or solicitation by Galaxy or any of its affiliates to buy or sell any securities. I'm not quite back in New York yet. I'm here still away, but it's a great conversation with both Beimnet and Luca. I know you'll enjoy, so let's hop right into it. Let's go now to our friend Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome back to Galaxy Brains.
Thanks for having me.
Oh, man, it's been exciting. I haven't been in New York in a few weeks, and I'm still not. But gosh, Friday night last week, October 10th, I was in the air, and I fell asleep for about 30 minutes. Bitcoin is 121,000. I woke up and had to double take 108 is what I saw at one point. I know it went a little bit lower. All of this, though, we're not going to do a whole rehashing of that flash crash. Galaxy Research has published a research report with some of our rehashing of that. But let's talk about the underlying cause, which was tariff tantrum 2.0. Trump posted something broke down between him and Xi, although it seemed like mostly on Trump's side based on some of the stuff coming out of Beijing. He threatened 100% tariffs on China enacting November 1st. That set off a massive dump. And obviously in crypto, it was mostly after hours. Let's focus on how it's gone since then. It's Wednesday, October 15th at 2:30 p.m. Eastern. How's it been going since that tariff tantrum?
Well, Trump immediately walked things back over the weekend, essentially saying that the China situation will be fine. And you've had, Trade Representative Greer and Bessent kind of, talk things down a little bit. However, what's interesting this time is the Chinese seem to be a little bit more aggressive. Right, the additional tariffs were announced because of new formal guidance issued by the Ministry of Commerce regarding, export controls on rare earth metals, and there was some other things like, a retaliation for some of the ship stuff that's been going on as well, and I think if you're in the U.S., you should be very concerned because the Chinese seem to have a willingness to go all the way. In fact, that is what they said this week, where, if they choose to fight, if the U.S. chooses to fight us, then they will take it all the way and fight us in terms of trade. And so, I think you're at the point where either Trump backs off or, it escalates. And it's a pretty binary outcome. The kind of my baseline is that there is some sort of resolution that isn't really negative, because the ultimate premise around trade is that nobody would trade unless it was mutually beneficial, right? And so, when two of the largest economies in the world don't trade, both parties end up worse off. And so, I think with that in mind, I think there will ultimately be a resolution. It's just a question of who backs down first, and can they do it in a way that kind of saves political face. Yeah, that's kind of my guiding philosophy, and I think risk markets are probably not appreciating how aggressive the Chinese are being in this tariff tantrum.
They're kind of mostly focused, it seems like, the risk markets. I mean, stocks opened okay on Monday, even crypto. Bitcoin bounced back to 115. I think as we write this, what we're trading around 111 or something like that, as we say this on Wednesday. But they seem to be mostly just discounting the Trump side of this, saying, well, Trump's come out hard and then walked back so many times. But you're saying don't underestimate the sternness of the Chinese, the seriousness of the Chinese don't seem that willing to bend here.
Correct.
And this rare earth thing, real quick. This, you're right. I'm happy you pointed this out. This is the Chinese produce what the largest producer of things like what, lithium, uranium, like what else are we talking? What other earths?
All sorts of things that are in
weird
so
metals
many
that you need
different
for
everyday
technology.
products. Yeah,
Yeah.
like between cell phones, automobiles, air conditioners, like certain plastics, like you name it. If there's a rare earth metal that's needed for a processed good, there's a high likelihood it came from China.
And so they signaled that there would maybe be some tightening. You said export controls, so possibly even reduced exports, not just like.
So I believe the stats so far, before this formal guidance came out, rare earth exports in China were down by 33% in September. And so you already had kind of, the tea leaves, and this is from like Chinese data, so I don't know if it's accurate or not. But like they were already kind of like constricting that supply. And if you really think about it, like if we're moving towards a more isolationist world, you kind of want to leverage your strengths sooner rather than later, right? Before the US has like enough like critical mass in terms of like rare earth metal supply that they can like securely source for their industries and defense, etc. So like when you have the leverage is kind of now, when we haven't kind of shored up that domestic production or trade with other places that have it. And so I feel like the Chinese strategy is actually pretty good. And it kind of seems like there's a lot of chatter around does the administration really have appetite for equities correcting? Because a full-blown 100% additional tariffs on November 1st, right, that would definitely send markets a lot lower. That would increase unemployment. That would drive inflation higher. And so I essentially China's like telling Trump that like they will take it there, and the consequences are you're going to not be popular domestically because markets will be tanking. And if you don't want that to happen, you are going to have to concede to the Chinese. And so that leaves you in a little bit of a quagmire, sticky situation. And ultimately, I think it's going to take two to taco. I'm borrowing this phrase from somebody else, but I really like it. It's going to take two to taco, essentially.
Yeah, that's hilarious. Let's also talk. I just want to. I don't know if you. Why has China got all these rare earths? Because surely we've got them too. I mean, we've got one of the most diverse topographical maps in the world. Right, incredible geography in the United States. It surely must just be that we haven't developed them. Right.
I mean, I think there's some element of that. But again, I'm not like a rare earth person or geologist or
Damn it,
one of those types of people. So I'm not exactly sure, but the whole idea is that like building out those capabilities takes time. And you can't just be like, oh, there's a deposit there, I'm gonna just start mining it. But because like there are multiple stages to like taking a rare earth like from the ground and making it processable for like goods, right? And so like there's a whole lot of things that go into it outside of just like having the resource. And so we are behind. Now, like in an ideal world, that is what trade is meant to do, right? Trade is meant to be like, oh, I am America. I have tons of wheat and soybeans. You want some of my wheat and soybeans. I want some of your rare earth metals. It's cheaper for me to, produce rare earth metals on a relative basis than it is for you to, produce soybeans. So we trade, and everybody benefits, right? Like that's the beauty of it. And I get the premise of like, trade policy's been more skewed towards um, you know, foreign places just historically because the tariff rates on U.S. imports into their nations have been higher. There's been a lot of intellectual property theft, etc. But that doesn't necessarily mean that you need to recoup all of the past losses with like high tariffs now, because it just leads to like very suboptimal like outcomes for everyone.
All right, let's go into something you are an expert and or at least a professional hobby horse in, which is the U.S. Federal Reserve. Jay Powell said on Tuesday, so that's yesterday as we record, that the end of the central bank's long-running effort to shrink the size of its balance sheet may be coming into view. He specifically said he was asked if whether there might be enough liquidity in the financial system to allow for firm control of short-term rates and normal money market volatility. Powell said we may approach that point in coming months, and we are closely monitoring a wide range of indicators to know if it's happened. He's talking about ending quantitative tightening. Is that right?
Yeah, he is. But it's already
what does that
like
mean?
essentially, like the Fed will stop reducing its balance sheet and it will keep it flat. It'll reinvest proceeds as, securities mature. And essentially he's doing that because the front end of the money market is drying up a little bit. And that's largely a function of just a crazy amount of treasury issuance. I think in October alone, you were expected to get $150 billion in additional bills beyond what's maturing, and just in T-bills, and then in notes, bonds, and other securities that the Treasury issues. I think you're talking about another $150 billion in supply, right? And so if you're talking about a month where you're going to need $300 billion worth of cash in the market to buy all the new treasuries that the government is issuing, like you're net draining reserves from the market. And if reserves are tight, that will cause stresses in the money market. And just to highlight, like I talked to a pretty senior front end rates trader, the other day, and he basically says, the market is currently in a position where like the standing repo facility could get tapped any day. Like it's totally possible. And that is just simply as a function of the fact that we've just been issuing a ton of treasuries, and the excess cash in the market that you could observe in the reverse repo facility has been completely drained. And so if you're in a situation where the reserve market is kind of like at a tight point, it makes no sense to be doing QT. In fact, you're going to be synthetically doing QE if the standing repo facility like actually gets some usage. And so like it's a natural kind of like front end money market operation, but don't get it twisted. Like if the Fed starts injecting money into the system via the standing repo facility, they will just call it, like front end liquidity management, etc. But effectively, it is an expansion of the Fed's balance sheet. It is QE,
Which is money printing at its core,
correct.
right? Yeah.
Correct.
Yeah. So when they say they may halt quantitative tightening, tightening is them selling treasuries and securities into the market, right?
Or just not reinvesting the proceeds of
letting them roll off, basically.
Correct. Yeah.
But that would, and to your point, this would be a first step towards some type of easing, whether by name or not, right?
Correct. And there's already an inconsistency in Fed policy where, I personally, if you're cutting rates and you're talking about cutting rates much more aggressively over the next 6 to 9 months, and you're simultaneously doing QT, like I don't find that intellectually, honest. Because one policy is tightening monetary policy, the other one's loosening it. Like, which one are you wanting to achieve?
Yeah, they should go hand in hand theoretically, right? So
correct. But the problem is the Fed balance sheet got so big during QE and COVID that it's just it leaves you with this like how do I phrase it? There's a reason that gold has doubled, right? And is making fresh all-time highs every day, because the whole world knows that Fed balance sheet number is by definition going to have to grow. It has to. If spending continues at anywhere remotely close to the pace that it has been over the past couple of years. And that eventuality is just it's there. And so the idea of like, oh, you've taken the Fed balance sheet from like $8 trillion to $6 trillion and you had to stop. Or I don't know the exact figures. I think it's come off by like 2 to 3 trillion. But like you couldn't even unwind what you did during COVID. You're not even back to like kind of where you were. And
He
you're
wanted to
about
try. You're saying
you
got it
wanted to
so
try.
theoretically you should be in a equilibrium where when in times of stress you run it up big, but then in the good time you bring it all the way back down to even or zero. That way you can run it up again if you need to. But you're saying like almost like the debt, like it just keeps. He ran up 100 and pulled back 20, right? Like it's like the best they can do.
Yeah. And
Nothing
but
stops this train. It sounds like, honestly.
nothing stops this train. And here's the thing, like the administration has no care in the world about what's going on in like gold and silver and the debasement narrative that's pervasive across the market, right? Like I think Besant was asked about gold today, and his response was more buyers than sellers, right? Like these moves are absolutely insane. It's literally the world's largest asset right now. Right, like maybe I'm
No, it's the largest
that's
asset
accurate.
by
It's
far. It's worth $30+
and it's
trillion.
moving 2% a day higher.
Yeah. It's crazy out there.
One way you can think about it is the dollar's moving 2% weaker a day.
Yeah,
versus the world's largest asset.
Well,
and I don't understand how that's not like alarming to folks, because what it signals is there's a massive policy error being made by the largest economies in the world, and it's simply unsustainable. We've all known this, but it takes moments like gold ripping every day and silver mooning every day to actually get people to realize like, what's going on?
Well, I don't know, as you've said many times, if our policy makers will admit what's going on or even be able structurally to see it. But I'll see you in New York next week, my friend. And until then, Beimnet Abebe, our friend from Galaxy Trading, thank you so much.
Thanks for having me.
Let's go now to our guest, Luca Prosperi, CEO and co-founder of M0. Luca, welcome back to Galaxy Brains.
Thanks for having me again, Alex. Always a pleasure.
It is funny. I've been traveling, and so I'm working from home this week. You are traveling, but you're in my home at the Galaxy Brains studios in New York. So we're doing a role reversal here.
Yeah, exactly. I'm enjoying your space.
Well, I'm very happy to have you on for a number of reasons, not the least of which that M0, big stablecoin company, just raised a new round, and we want to get deep into stablecoins with you, Luca, one of the most thoughtful people I know in the space on stablecoins, and so much is happening there. But before we get to that, you also have some hot takes and big thoughts on the sort of, I'm going to call it the October 10th flash crash that happened a week ago in crypto. Before we even get deep into it, what is there a stablecoin story there, or is this more of a DeFi, CeFi type story? If there is a stablecoin story, like what was the stablecoin part of that story last week?
Yeah, I think on the surface there is a stablecoin story, but in reality, it is really a DeFi, CeFi, fabric of finance story with some good takes on how actually to embed derivatives or protocols within other protocols. But it's very interesting. I think that the beauty of DeFi is that we are seeing in the open all the mess that used to happen within closed source balance sheet of investment banks like 20 years ago. So it's a lot of fun to crowdsource opinions on how to connect the financial fabrics of the world. It's pretty cool. So I mean, I think on the stable coins, obviously the USDE Athena stablecoin was at the center of the debate here. Now, I think Guy, the Athena team, and Guy especially, I think is one of the smartest founders and builders in this space, and I have always had a lot of respect for him. But obviously, Athena is not a stable coin, USDE, and I think there is a good segue on how we should embed assets in crypto in certain DeFi protocols and leverage, just not doing it at face value, but trying to understand deeply what is the risk profile behind what we're doing. So very, 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 very interesting times for like a DeFi former Fig nerd like myself.
Yeah, it really was, and so the USDE, which I don't know what they call it. I think they've called it a synthetic dollar in the past, but it's a dollar peg stable asset is what it intends to be. Not a stable coin in that it's not collateralized the way other stable coins are collateralized. It depegged on Binance specifically, is my understanding, not affected. Not the result of any kind of issue with minting and redeeming or the collateral at actually Athena, but sort of inside the Binance order books shortly after the big crash happened. And I understand this to be mostly a Binance issue, but it does raise questions, right? Because where you get the value of such an asset, whether it's from an external oracle or from your own order books, or if you hard code it, for example, I think USDE was hard coded to the price of Tether on Aave, which actually made it perform quite well during the crash there, but has its own. All of these setups have their own. It's all about risk transfer, right? It's not like, Aave is a great example. What if USDE was fine, but Tether traded below the peg? Then on Aave, USDE would have looked like it traded below the peg, right? There's only like sort of, it's a ball of risk. It has to be worn somewhere by the traders, right? And it seems to me part of the confusion as it related to USDE and Binance was that people weren't exactly sure where the risk actually lied in that instance.
Nomenclature is important, right? And USDE was originally marketed as a stable coin. I think it went out of hand. The team realized it, and I think if you talk to the team now, they are very clear in saying that this is a tokenized, wrapped, basis trade strategy type of hedge fund product. So it is not a money market instrument at all. I think that the idea that it trades around a peg is a good marketing tool so that you can actually measure the yield you're gonna get from it at the par value, and you say it yields 10, 12%, 5%, whatever. Now, obviously, even if USDE would be redeemable at 80 cents in the dollar, it doesn't mean it's not a good product. Like ultimately, you need to do like your yield to maturity type of calculations. So I think that and I'm sure the team would agree with me. I think that what is interesting is like nomenclature is very important, because like you really need to treat some stuff for what it is. And I think in the case of USDE, in some cases, it is really treated instead as a stable coin in the fabrics of DeFi, how you use it to source leverage or to provide leverage. And I think what is important, and we have seen all this debate about should oracles work here? Should oracles look at secondary prices? Should oracles look at the NAV, so the net asset value that is behind the product? It seems a very nerdy topic, but it's actually fundamental. First of all, like, talking about the irrelevance of secondary market and the concept of peg in the same sentence doesn't make any sense whatsoever. My point is exactly what you said, Alex. Like, there is no free lunch in finance. And so if you are hiding volatility in one place, the volatility ends up being in another place. Like if you're taking assets and you're saying, I'm just hard pegging an asset one for one, what it means is that you're saying, I am ignoring the volatility, the underlying volatility of that asset, because I think it's not important, but somebody needs to swallow that risk. And this is very typical. Like, I've been a financial investor all my life. And this is what happens in balance sheet of banks, right? Banks, they're not mark to market their balance sheet. For depositors is fine, assuming that it works. And then if there is a problem, and then the balance sheet snaps in one go, and the people who stay in, they pay the price for everyone. And I think this is very similar, right? Like, I mean, if you are like locking something in one environment, you're hiding volatility. It's like a earthquake, and then you need to hope that this stuff is not going to blow up in one go on your face. The problem in DeFi is that there is so much leverage in DeFi that any level of turbulence at the underlying asset level can really create huge problems across the fabrics of DeFi. So I think We avoided we avoided a lot of turbulence because of the way the oracles were constructed. But as you said, like oracles are app-specific risk management tools, and we should look very, very carefully what it means, right? Because otherwise we're actually saving ourselves from a small problem and building up a way larger problem for the future. This is like, financial crisis 101, but we're just seeing it now in live form through DeFi products, which in my opinion is great and very beneficial for the ecosystem, because we can have open debates. We can see what is actually happening throughout the stack.
Yeah, I think there's a lot to learn, as you pointed out. And it's funny because, for people building in DeFi and building this new financial system, it is important to learn at all these things and look at this minutia. I think when I talk to macro and institutional investors about what happened, the story is pretty simple from my perspective, right? Perpetual DEX trading became the main narrative in crypto over the last 3 months, with Hyperliquid's rise and then Aster competing, and then everybody just trading perps everywhere, right? And open interest got huge, and then you have a end of day market moving macro headline, and lo and behold, there's a big leverage wipeout, and there is microstructure to look at, right? But just broadly speaking, I think I think sort of reminding the institutional investors that like there's microstructure, but the DeFi builders need to really be looking at that and understanding how to better build that microstructure and what, take learnings from this. But the broader investor takeaway is relatively straightforward here. If you play with large leverage and during times when liquidity is thin and the risk of a Truth Social post is high, like you should prepare to be burned, right? Like that's the simplest answer here, right?
Yeah, no, absolutely. And also the answer for the crypto capital market, which is very yield hungry, is there is no free lunch. So if you actually have yield that is 10% and the risk-free proxy is 4%, who is actually giving you 6%? Most of the times is leverage. So if you're building leverage on leverage, you really need to pay attention and just always remind yourself that there is no free lunch. And how you construct the products that you're constructing for your clients, it is very important, because you're not the smartest person. You're just like, you need to know exactly what type of risks you're underwriting in your stack.
And it's also very likely that there's nothing new under the sun. People have tried these things in finance in various forms over the years, over the centuries in some cases. So don't get the hubris that thinks that like, like stablecoin lend and borrow looping is like a brand new invention. No, like leverage on leverage has been tried many times, and we're aware of the maybe the rails are new. The rails are new, and they do bring some key benefits. Let's talk about some of those now, Luca. I want to talk about M0, but let's set the stage a little bit with the Genius Act, the landmark stablecoin law now signed into law by President Trump in July of this summer. It's called the Guiding and Establishing National Innovation for U.S. Stablecoins Act. The Genius Act, a lot of people worked really hard on this. I know both inside the government, on Capitol Hill, and in industry, providing technical assistance on this bill. I'll set it up broadly. The bill creates a federal framework for stablecoin issuance. It includes rules on collateral management and risk management for the issuers. It also imposes rules on digital asset service providers like a Galaxy on which we can use and how when we can use them. It also creates, just as an aside, a state pathway to issue one up to a certain threshold if those states' regulatory regimes are, materially comparable to the federal one. So it raises everybody to a federal threshold, but still allows states to do it. Just broadly, what's your take on this act? I mean, this seems like an incredibly consequential financial bill, monetary bill. I would say definitely the most consequential since Dodd-Frank was passed in the wake of the great financial crisis. Perhaps even more so long-term, yet to be seen. But what's your overall take on Genius?
I agree. I was quite vocal during the drafting process. I think this piece of legislation has incredible consequential effects in the fabrics of finance that most people do not realize yet. And in my opinion, the main point is the following. Until recently, until like still now in certain jurisdictions like Europe. And I'm European. I spend a lot of time in the European financial institution space. So fortunately, unfortunately, I know well the ECB regulatory environment. Any form of so until now, like banks were acting as the main distributors of M1 money, expanded money in the system. Banks were underwriting credit, they were just distributing money in the economy, and they had the benefit of the monopoly on deposits. So you had to park the money there. That money is virtual, of course, and banks were actually doing the distribution and the management of clients' relationship. Now, this stuff has changed over the last 10, 20 years, right? If you look at if you talk to a person like under 30, probably they never stepped into a bank branch in their life. So they don't need banks for distribution or storage. So like there has been a tech overlay on top of the banking sector for a long time. Until now, though, this tech overlay was just an overlay. So the banks were the banks and the fintech companies were just operating on top of it. So any tokenized form of money was like some sort of like electronic money on top of deposits. So we were not actually reinventing the stack to actually create money and distributing into the system. We're just creating a distribution tech overlay on top. Now, this Genius changes completely. What Genius is saying is that there is a new vertical, like some sort of narrow bank stablecoin monoliner issuer that can create digital money fully collateralized. That's why they're talking about payment stablecoins. It's M0, not M1. But you don't need to rely on the banks to deposit your money. And this is fundamental, because what happens is that if you're an app builder, you're saying, okay, I need to have digital money on my stack. What can I do? I can connect to a bank through APIs, and I'm running their counterparty risk, and I need to interact with their stack, which is antiquated, and I'm bringing them free flow of funds. Or I just do it on stablecoin rails. Safer. There is no counterparty risk for the depositor, tech-friendly, super fast, and programmable. And obviously, banks do not like that at all. And I think that it is really fundamental in realizing, I think consciously or unconsciously, that we will reinvent layer by layer the whole stack of money transmission in the economy. I think this has huge fundamental impacts in the banking sector, because some banks that do not really have a competitive advantage in other products will see a liquidity crunch. Liquidity will move. Why would you need to park your money in a regional bank as just a parking spot if you can do it through stable coins in stuff that is fully collateralized? So we will see like a complete reshuffle of the banking sector in the next 10 to 20 years. I'm convinced of that. So I think that and this this creates a lot of obviously regulatory clarity and some sort of Cambrian explosion of stablecoin issuance in the US. But the last point I wanted to make on this is, and this has been our thesis at M0 for a long time, and Alex have been researching in stablecoins space before M0, so I'm not trying to preach at all. It's just my conviction. Issuance itself, people are obsessed about issuing a stablecoin. Issuance is the least relevant piece of the stack. Issuance is going to be commoditized very quickly. It's going to look like custody for securities. No clients know who is the custodian of the securities that they are trading on Robinhood. And if Robinhood changes the custodian, they will not care. So most of the stuff will happen at the infrastructure level, and the applications will just deal with infrastructure, and behind the scenes there will be issuers that just are custodians and guarantors and compliance providers. So I think that is interesting that now we will see a lot of banks trying to morph into stablecoin issuance because they think they need to do it for competitive advantage reasons. But it's going to be tough for them because they have a huge conflict of interest. So for me, it's a big bang in how money is intermediated and created in the largest economy in the world. So we've just started to see the impacts in the competitive landscape now. Okay.
Let's talk about your conviction here, Luca, as you mentioned, and get into M0 then, what you guys are building, because it's very interesting. It's obviously extremely relevant. And I'll preface this by congratulating you. You guys announced in August that you raised $40 million in a new venture round led by Polychain and Ribbit Capital. So congratulations. Maybe before we get deep into it, remind the audience, and I encourage people to go listen to the episode I did with Luca last fall in fall 24, but remind the audience, broadly speaking, how M0 works and what your sort of take and angle is on the stablecoin market.
Yeah, and I promise I'll try to be short. It's just that sometimes you need to rewire the way you look at things. So our conviction at M0 has always been that money is infrastructure. Money is infra, it's not a product. And when it comes to digital money, stable coins, we thought that this market has two sides. The people building cool stuff with money and the people, the institutions issuing the money. These are two different markets. So M0 is an infrastructure middleware, infrastructure lien that separates the two things completely. So if you are an application builder, like if you're a new DEX or a crypto-powered credit card or an exchange or a chain or a DeFi protocol, you can embed money in your stack only with code. The rest is abstracted away. You can do it only with code. You can program it, stream yield, do compliance, interop, liquidity in and out, just interacting with the M0 protocol. So it is a protocol. On the other side, on the issuance side, you can just use this protocol to do issuance and sell into this market. So we are completely bifurcating the two sides. So M0, ultimately, we want to be the best application-friendly money infrastructure there is. And it's we are in the world of stablecoin centric chains, etc. I think we don't believe in stablecoin centric chains, so we created a protocol that is completely completely blockchain agnostic, and it just wants to focus on the interoperability, liquidity, and programmability of the money for app builders. These are our clients. So, I'll stop here, but we started with this thesis in the company that money is not a product. Stablecoins are not branded products. Money is infra. People struggled to wrap their mind around what we wanted to say, but now it's becoming real. Like you see all these companies from Stripe to Circle to Tether through Plasma, they are building infra for interop, exchangeability, liquidity of digital versions of money. This is the most important thing. So that's what we have been pioneering at M0, and it's great to see crypto native VCs like Polychain and very opinionated fintech investors like Ribbit joining our journey.
Yeah, so M0, you're building this infrastructure, as you say. It's a platform for other businesses to issue, mint, manage stablecoins. Is that right?
Yes. Not even to issue. I think the issuance is not really important, but to control their dollars.
Yeah. And so it seems like an incredibly ingenious, dare I say, perfect design to address what you called that Cambrian explosion that Genius Act is propelling, right? Where everyone thinks they need to issue a stable coin. Maybe there's, a better way rather than every single one go get what they call now a PPSI, a permitted payment stablecoin issuer license from the OCC or a state regulator. Would M0 be the PPSI in this setup, you think?
No, I think M0 is a tech layer. It's simply a tech layer. So these guys can use it, and I can have a practical example for what we're doing for MetaMask. M0 is the platform on which MetaMask is launching their MetaMask dollar. But this tech layer is allowing those issuers to deal with the smart contract platform, the programmability, the interop, and everything. Everything I'm stressing, I tend to repeat always the same stuff. In money, everything is about liquidity and interop. I think the struggle we're having in stablecoins is that our mental model is created around the first two success stories that are Circle and Tether. These success stories will not repeat themselves, especially Tether. These are like fat stablecoin companies. What I mean is they control everything. They control the brand, the minting, the custody, especially the distribution and the liquidity. This is not replicable. And I think probably only Tether will succeed in doing that. All the others will need to operate within a fabric that connects applications, custody providers, issuers, liquidity providers, and it's all about this interoperability. Ultimately, this will be completely abstracted away from the user. The user will interact with an application. They will see a dollar balance on their application, and behind the scenes, instead of having old rails, there will be new rails, and stablecoins will be these new rails. In my opinion, stablecoins are networks, are like fat networks, and most of that stuff will exist on chain, and that's what we're building in M0. So it's a very complicated, very complicated stack, but has different pieces.
Yeah, that liquidity primacy in your mind, that's sort of the idea here with M0, is that these many different issuers can get fungibility and centralize the liquidity instead of a bunch of individual issuers like a Tether and a Circle sort of trying to build an entire stack on their own, and then you have to swap them in secondary markets, right?
Yes, they can use all these different issuers. Let's look at from the issuer side, and most importantly from the application side. All the different issuers can use the same set of smart contracts. They can actually decide what level of interop they have within the stablecoins they issue and the stablecoins others are issuing. They can decide what is predicated on secondary liquidity, what is predicated on tech interop. So they can actually compose their stack and integrate with others in a way more efficient way. And they do not need to chase their own distribution. Like I was like, if there is a bank X that says we are issuing a stablecoin, that act of issuance is completely relevant unless that stablecoin is embedded in an application that everybody uses on a daily basis. So I think that the idea here is the issuers are just connecting with a stack that is ready for them and gives them all the benefits of interoperability, issuance, liquidity, shared programmability, etc., without them having to invent it. Now, on the other side is even more powerful. So if you are an app builder, you can just like integrate a set of smart contracts on the M0 network, and all the issuance, all the connectivity with the banking rails is completely abstracted away from you. You just deal with code. The rest you ignore sometimes. You can be opinionated and say, I actually want to use this stack, but I want company X to be the issuer of record because I have certain requirements. You can do it, but the tech layer is the same. And this is very, very important for new companies that are building directly on digital rails. I give you an example. I think the best example is what we have done for MetaMask. Like, people know MetaMask. MetaMask is probably the most famous, the most important, the largest, if not the largest, wallet infrastructure company everybody uses. They have 30 to 40 million monthly active users in their non-custodial platform. They wanted to have a stable coin for their platform. I stay away from the idea of issuing a stable coin again because it's not really the important part. They say we want to have a MetaMask dollar. And the MetaMask dollar needs to be integrated with our layer 1, with our layer 2 Linea, needs to be integrated with our swap markets, with other stuff, other products we're building on top for their stack. So they had a lot of tech heavy requirements, and they decided to build it on M0. Now they also had a requirement, regulatory wise, that they wanted the MetaMask dollar to be to have a parent from a legal perspective. So we decided to partner with Bridge, a Stripe company, to be the issuer of record of the MetaMask dollar. So what it means is that Bridge has the licenses to store the collateral off chain and to give birth to the MetaMask dollar through our set of smart contracts. The entire tech stack, the interop, the way the liquidity, the way the stablecoin is delivered to the customer, and the way it moves within the MetaMask consensus ecosystem and outside of the consensus ecosystem is entire M0 tech. And others could do the same using the same tech layer.
So will MetaMask themselves, I mean, maybe you don't want to speak to them, but I'm assuming then they would be the permitted payment stablecoin issuer from a regulatory perspective, or perhaps they yet also partner with another third party?
No, I don't think they would be. I think the permitted payment stablecoin issuer would be Bridge in this case. And MetaMask simply consensus will have certain control at the smart contract level, and they will embed this product within the set of non-custodial products they're offering to their customers. So they will be in control of the experience. The permitted stablecoin issuer is Bridge, but in my opinion, the issuance business per se, it really will resemble more custody in the securities world. It is going to be a highly regulated, low margin, commoditized business per se.
That makes sense. I think you're going to see then, sounds like in that world, you probably see sort of a handful of highly specialized, effectively white label issuers emerging. Like, for example, I know Anchorage will be the issuer for USAT, which is Tether's onshore foray, I'll call it. That's what they announced at Token 2049. Presumably, right, and Anchorage is a national bank, OCC regulated national bank, obviously in a very good position to get the whatever accompanying OCC license will be required to be a PPSI. Sounds like Bridge will be, right? But how many of these is your? You were saying this at the top. I don't know if it's a fear or a prediction. Do you think all the big banks that say they want to do a stablecoin, you think they're all going to miss this boat, or are you guys going out to them, and all try to go get their own license and all build their own silo and all hold, get a JPM dollar, BNY dollar, all these different dollars and not see the light of the tech interoperability? Are they at risk of making that mistake, building their stablecoin in COBOL and keeping it inside their four walls?
I think they are at risk. And I think that a lot of them will make mistakes. A lot of them will be not needed in this future. I think again, that the act of issuance per se is going to be commodity. So what is going to matter is what you can offer around it. So if you're JP Morgan, for example, and you offer a lot of adjacent services around a potential JP Morgan coin, you're in a good position, right? And if you want to interact within the JP Morgan ecosystem, you need to use the JP Morgan coin, and you can get credit and I don't know, whatever, like OTC derivative desks, whatever JP Morgan can offer to you. But what matters are the services. The issuance per se is commodity. And in the case of Bridge Stripe, for example, we're seeing, because Bridge is fully integrated on M0 Stack, we see a lot of potential customers very interested in having Bridge as the issuer of record because of the access they can have to the Stripe suite of services of payments and integration with merchants. So it's all about the services you can provide around. Anchorage, another example, like we're very close to the Anchorage stablecoin team. We hope Anchorage will soon use M0 as a tech layer to issue part of the stablecoins they can issue. But the issuance per se is not sufficient to win. And I think that a lot of banks are struggling. They think, okay, if I am a famous bank, I will issue a stablecoin, every user will come to me. The user doesn't care. The user trusts the application layer. So unless they build the application layer, which is a completely different business, they will be just squeezed. So I think that it's interesting. I think we will have few white labeled massive issuance businesses. The issuance business, I think, is going to become digital very soon. Is going to be probably most of those securities will be tokenized, treasuries will be tokenized, there will be smart contracts, there will not be trusts. So that stuff is going to be very programmatic very soon. And if you want to create a financial institution around stable coins, you better focus on the additional services you're providing to your clients. Otherwise, you're just going to be irrelevant.
Let's continue this sort of line of thought. One of the interesting things that we've seen come out of this, and I know Bridge is sort of one, which is obviously Bridge is part of Stripe, and Stripe has announced that with sort of a consortium of partners, including, I think, with Paradigm sort of leading that they're going to build their own stablecoin focused blockchain. Tempo, I think Circle has said they're going to build, I think theirs is also their own chain. Arc, it's not an L2. And then, of course, there's this Plasma XPL chain that is, I don't know, Tether backed. I don't know if Tether's actually building it. That's at least three that are sort of corporate stablecoin chains. That seems like maybe making the wrong decision, trying to keep it all inside of a silo. What's your take generally on these sort of corporate stablecoin chains, and how does M0 see that as a pathway?
Yeah, I am bearish corporate stablecoin chains, and I hope I'm right. because I come from the crypto early day anarchic crypto open source cypherpunk side of the industry, and I hope we keep winning because having an open architecture financial system is so much better and so much cooler to build on. Now, I think that it is going to be very difficult for stablecoin centric chains to be successful because they need to convince people to build stuff on top of it and assets to flow through their pipes. And currently, large banks have tried it, right? And large banks ended up adopting Ethereum. And the adoption of Ethereum 5 years ago would have been anathema for most of them. And I'm pretty happy we got there. Now, I think some are in a better position than others. I think Stripe is in a good position because they have their own captive network of merchants. They can bring, and in the Stripe story is interesting because Stripe, and I mean, I know the bridge team very well, but I'm just, these are my opinions, in no way connected with what their strategic position might be. I think Stripe is in an interesting place because stable coins are a huge opportunity for them, but also disrupting their business. So I think creating some sort of stablecoin centric chain is a way also to reduce their own internal marginal costs and sideline Visa. So this is a network fight. And I think that we're going to have new networks emerging. There's going to be a new mesh of networks. Now, I think it's going to be difficult. I think I hope we will be in a world of open architecture chains for the future, but there will be also like closed loop chains that are optimized for certain use cases. So everybody's threatened here. It's interesting how we're going to reshuffle the balance of power in the next decade or so. Then, of course, like, we are not naive, and there is a huge equity premium in creating chains. So everybody wants to capture that premium in the form of tokens that are sold to investors if they launch their own chain. And I hear in the market that the Tempo chain is not existing yet, but there is already a price for token warrants. So that is also a reality.
Yeah, it does seem to me a little bit of a step back, or another way of saying it is everything old is new again. With you remember the old enterprise blockchain, and then I think you're right. The enterprises made great strides, and I think finally realizing that public blockchains were the place to actually build, and then and that you could do some of the impetuses that had led to the enterprise blockchain thesis, that you needed to control them more and you KYC users and stuff. The tech has emerged such that even on public chains, you can accomplish a lot of that if you wanted to do that. It does seem like surely they could, and in fact, I would say even from the Ethereum standpoint, the fact that some of these are all three that I mentioned, I believe, are new L1s. Like surely the Ethereum roadmap had been designed where these could possibly be corporate L2s. We see a lot of those with like Robinhood and Kraken and Coinbase, but I'm just surprised, like full new L1s, and they say that stable coins will be used for gas, which is the other, I think, very, from a user perspective, very positive, but doesn't that take away sort of one of the main reasons to launch an own L1, which is to build your own token, have your own validator network? It's all, I guess a lot remains to be seen, but it feels a little bit enterprise blockchain-y to me.
I agree. At M0, we decided not to build a chain, even if we were very early in the stablecoin adoption war. We decided to create a set of protocols and standards that are chain agnostic. But we are cheering for the open architecture side of history. So we will see.
Yeah, I think we will see. we will see. It could be the whole thing. I mean, I can never forget IBM saying they were tracking tomatoes on their blockchain from ground through Maersk shipping to whatever happened to those tomatoes. I'm assuming they got to their destination. It does make me wonder, but there is obviously a huge green field upon which to build now, thanks to the legal regulation and adoption, promotion even by the Treasury Department of stablecoins in America. So it is going to be, this is why I say it could be the most consequential change to money. I mean, honestly, since like 1971, Dodd-Frank is financial regulation, right? Like it puts safeguards and adjusts how like intermediaries have to be regulated and overseen. this is a more, like to your point, M0 base layer upgrade potentially that is so interesting. But you do a lot of work in Europe, as you mentioned, you know, a lot of ECB and stuff. What's your take, Luca, on Christine Lagarde and the ECB's continued insistence on the the central bank issued digital currency stablecoin? Obviously, the U.S. going a whole different direction with these, you know, intermediated two-tier banking system, privately issued ones. What are they thinking over there?
Since I became a founder and an executive, people always remind me that I need to be very filtered in my opinions, but you only live once. I decided not to follow their advice. Sorry, guys. I lived most of my life outside of Italy, but as you can tell from my accent, I am Italian. And my own personal hero, as for many other Italians, is Mario Draghi. I think was the greatest central banker we've ever seen. I was working at Morgan Stanley during the whatever it takes times, and he just destroyed the European sovereign debt crisis with one sentence and a lot of credibility. Now, I think Christine Lagarde is probably the worst central banker we've ever had in Europe, coming right after, unfortunately. But a lot of her, like the posture of her as a central banker and the sense of complacency against Bitcoin or digital asset rails is a bit depressing. But I think the reality in Europe is slightly different. Like, it is quite clear that the ECB space is trying to protect domestic banks. They know, because the central banks are very, very smart. They understand the fabric of money better than anyone else. They know clearly that having stablecoin issuers or digital money issuer monoliners is threatening banks, because why on earth you need to deposit money in a bank if you can do it in an over-collateralized instrument which is digitally native and you control the economics of, and they are fighting for it. Now, I think that, and I know for a fact, because I heard stories about it, that the regulators in Europe were not very happy to see the U-turn in the US on stablecoins and crypto in the new administration, because now they're a bit cornered, because on the one hand, they're trying to protect their banking system, which is antiquated. On the other side, now they see the risk of seeing a ton of liquidity siphoned out of their system through USD stablecoins. So I think he's in a very difficult position. And as a European who doesn't live in Europe anymore much, or at least doesn't do business in Europe much, is sad, right? To see like such a large currency block lagging behind, while Europe actually had a possibility to be at the forefront of this during the Biden years, where the US were actually pushing out crypto business. So it's interesting, but I think this goes back to what you were saying before about what we're seeing, which is one of the deepest financial paradigmatic shifts in our lifetimes. This is also about geopolitics, and there are blocks fighting each other. The US, I think, had a very deep and smart understanding that this could be one of the most powerful rails to perpetuate the dominance of the dollar worldwide, and they're using it, but they're not the only block in this world. So it's going to be interesting. But Europe definitely has been very incumbent-centric and protectionist in the last couple of decades, and they haven't learned the lesson yet.
Yeah, it does feel like, I agree with you completely. This is a very geopolitical, geostrategic move by the U.S. Obviously, the Treasury Department and Secretary Scott Bessent has talked a lot about the increased demand for Treasury purchases that stablecoin issuance at scale could bring. Of course, that's helpful, but it's also by statute very short-term Treasury debt, right? Whereas America's Treasury market problem is really about the long end of the curve, right? Needing more long, and stablecoins by law can't buy, I don't think, anything later than a longer dated than a 92-day Treasury, I think, under the Genius Act. But the other thing that he said explicitly on, I think, March 6th at the crypto roundtable at the White House, Scott Bessent said, we will grow and maintain US dollar dominance and we'll use stablecoins to do that. It sort of seems to me like the geopolitical strategy here is, look, we know that there's declining interest in owning US debt. We know there's even in some cases, although I think it's a bit overstated, but declining interest in trading, international trade settlement in dollars. And we say, okay, well, I mean, we will work on that. But in the meantime, we're also going to make it really easy to just put dollars on every one of your citizens' cell phones. So it's a highly subversive geopolitical play, right? Like, try to stop the flow of dollars when they flow as easily as Bitcoin.
Yes. And also, I think it is the beginning. So currently, stablecoins are ultimately, I think stablecoins are balance sheets, right? Stablecoins are allowed to hold only short-term debt. That what is going to happen if there is some sort of like squeeze in the longer part of the curve, then maybe surprise, they will be able to hold like a longer dated debt and, I don't know, commercial paper. And they will start to resemble more banks' balance sheet. Or maybe we'll start having insurance companies that are building products on Bitcoin and stablecoins. They already are. Bain Capital and Pantera are two of my largest investors, and I think they just invested in a Bermuda-based insurer called Meanwhile, and which raised roughly $100 million to build an insurance, because insurers are long-term investors in assets. So you see how like the whole financial industry slowly moves on a different stack, and things go so quickly, right? It seems that it's taking forever, but I don't know, 5 years ago, what was the TVL of Tether's USDT? Definitely not 170, 180 billion dollars. So yeah, it is moving. Also, the way what we think of stablecoin is moving. We thought that stablecoin was a trading settlement asset, and then people like Nick Carter, myself, they started to say, wait a second, stablecoins are actually the next iteration of Eurodollars, offshore dollars. And now it's like, wait a second, stable coins are actually the new vintage of bank deposits. So this instrument is becoming way more pervasive and is absorbing and swallowing larger and larger parts of the financial stack. And I think now even if there is a change in administration in the next years, I think now this phenomenon is becoming so big that it is impossible to ignore.
And the Genius Act was passed by bipartisan veto-proof majorities of both houses of Congress. So it does look like this one is here to stay. It's about as good as you can expect or hope for any federal legislation, right? This was not partisan. It's not like one party is going to get into office and want to undo the other party's bill. Like, everyone voted for this bill except for a very small minority of Democrats. Before we wrap here, Luca, let's do that. You were winding back 5 years to Tether, and it was much smaller. I mean, it's been an explosive growth there at Tether, and in stablecoins in general. We expect that growth to continue, but let's go forward 5 years instead. We'll call it 5. Why not 5? Genius Act has to be fully implemented, I believe, within the next year. The longest dated implementations and compliance requirements for Genius are 3 years out. So by 5 years from now, we should be 2 full years into sort of full Genius Act world. Who do you think will be the biggest winners in that world, industry-wise speaking, or I guess you could say consumers too, but what types of entities will be the biggest winners in that regime?
In my opinion, the biggest winners will be the new fintech applications that are going to be built on stablecoin rails. I think maybe 5 years is short, but in the Revoluts or Robinhoods of the next decade are built. Are emerging now, and they are built on stablecoin rails. And this is where most of the value will accrue. There will be 2-3 very, very large networks that dominate. Hopefully, M0 is one of those. But this, in my opinion, will be the winners. We're just completely reshaping the way we do financial applications and financial intermediation. And I think the companies can launch on those rails so much faster. I mean, we have seen some companies, I think some of those companies are also Galaxy portfolio companies like Red Dot Pay, creating credit card products on top of stable coins and exploding in growth in a matter of like 12 months. Or the hyperliquids of this world, right? Built on digital rails and creating some of the largest perps in the world in like 2 years. And I think this is going to come. I mean, the first 6 months of 2025 was all about the stablecoin narrative following the acquisition of Bridge by Stripe. The second half of the year is this narrative is becoming real. We see massive shifts. So in my opinion, 5 years, if I had to make a prediction, the stablecoin float is going to be north of $2 trillion. We will start to see the emergence of very large stablecoin providers in other currency systems like the Mexican peso, the Brazilian real, the Indian rupee, etc. Maybe the euro. Who knows if these guys wake up? And we will start seeing huge financial companies built on stablecoin rails that are $50 billion plus of market cap.
Very exciting. Well, thank you for the insights, my friend Luca Prosperi, CEO and co-founder of M0. Check them out. And again, Luca, congrats on that latest fundraise at M0. Great having you.
Thanks, Alex. Next time in person.
That's it for this week's episode of Galaxy Brains. Thank you to our guest, Luca Prosperi, CEO and co-founder of M0, and our friend Beimnet Abebe from Galaxy Trading. Everyone have a safe and happy weekend, and we will see you next week. Thanks for listening to Galaxy Brains, the weekly podcast from Galaxy Research. If you enjoy the show, please like, rate, review, and subscribe wherever you get your podcasts. To follow Galaxy Research, sign up for our weekly newsletter at gdr.email, read our content at galaxy.com/research, and follow us on Twitter at GLXY Research. See you next week.